In this session, we will be learning about weighted average cost of capital. To balance financial risk, control over company, and cost of capital, a company usually does not procure entire fund from single source. Rather than it makes a mix of various sources of finance. Hence, cost of capital will be equal to weighted average cost of individual source of finance. WACC of company depends on capital structure of a company. It weighs the cost of capital of a particular source of capital with its proportion to the total capital. Thus, weighted average cost of capital is a weighted average after-tax cost of individual components of firm's capital structure. That is, the after-tax cost of each debt and equity is calculated separately and added together to a single overall cost of capital. So these are the steps to calculate the weighted average cost of capital. Step 1. Calculate the total capital from all the sources. So we had to add long-term debt capital, preference share capital, equity share capital and retained earnings. In step 2, calculate the proportion of each source of capital to the total capital. So how much the equity share capital weighs in the total capital, how much the preference share capital weighs in the total capital. So these individual proportion we have to calculate, and these will be used as the weights. Step 3, multiply the proportion as calculated in step 2 with the respective cost of capital. As we have learnt earlier how to calculate the individual cost of capital from different sources, now we have to multiply those calculated values with the weights which we have calculated in the step 2. And step 4, we have to aggregate, we have to add back all those costs which we got after multiplying with the weights, and that will be called the weighted average cost of capital. We can understand those steps with the help of this table. In this table, we can see that long-term debt have a 7% cost of capital and their weight in the total capital structure is 50%. So their contribution to the WACC is 3.5. And similarly for equity share capital, 1.3 is the contribution, and for preference share is 1.5. So total weighted average cost of capital here is 9.05. Now we will try to know and understand what is the importance of weighted average cost of capital. Security analysts employ weighted average cost of capital all the time when valuing and selecting investment. WACC can be used as a hurdle rate against which to assess the return on investment on capital performance. Investors use WACC as a tool to decide whether or not to invest. WACC represents the minimum rate of return at which a company produces values for their investor. Let's say a company produces a return of 20% and has a WACC of 11%. So it is preferable for investor to invest in a company which has a return higher than the WACC. And in contrast, if a company's return is less than WACC, the company is shedding value, which indicates the investor should put their money somewhere else. Now there is another concept regarding the weights which we have to use regarding the calculations of the WACC. So book value and market value are the two choices. If we are carrying book value, basically it will reflect all the share premium and reserves and retained earning into the book value of equity. And if we are carrying market value weight is more correct and represents the firm's capital structure. While using market value, reserves such as share premium and retained profit are ignored as they are in effect incorporated into the value of equity. Similarly, in case of debt, market value is better to be used rather than the book value of the debt. There is no separate market value for retained earning. Market value of equity share represents both paid up capital and retained earning. But cost of equity is not same as cost of retained earnings. Hence, to give market value weights, market value of equity shares should be apportioned in ratio of book value of paid up equity capital and book value of retained earnings. This small concept we will understand with an example below. Cost of equity of the company is 10.41%, while cost of retained earning is 10% and cost of debenture is 8%. There are 50,000 equity shares of 10 each and retained earning of 15 lakhs. Market price per equity share is 50 and 5,000 debentures with market value of 110 each. Calculate WACC using market value weights if there is no other source of finance. So here we have to use market values as weights. As we don't know the portion of market value of retained earning, we had to apportion them in the basis of book value. Book value of paid up equity capital is 5 lakh. Book value of retained earning is 15 lakhs. Ratio of paid up equity capital and retained earning is 5 lakh is to 15 lakhs. That is 1:3. Market value of paid up equity capital and retained earning is 50,000 multiplied with 50 per share. So that we got 25 lakh. So we had to apportion the 25 lakhs into the ratio of 1:3. So market value of equity share we got is 6,25,000 and market value of retained earning we got is 18,75,000. And for the market value of debentures, we can easily multiply the 5,000 debentures with market value of 110. So here market value we got in the first column and we got the total capital of 30,50,000. So with that we can calculate the weight. So we divided 6,25,000 with 30,50,000 and we got weight of 0.2049 and similarly for the rest. And the next column is cost of capital, which is given. Usually if the cost of capital is not provided, we have to calculate each source of finance cost of capital and then we have to implement in weighted average cost of capital. So now we can multiply the cost of capital with their adjacent weights and we can add aggregate of weighted average cost of capital. We got the answer.